Hello and welcome to a fresh new edition of the Global Reset with me, Prashant Nair. You're with us here on CNBC TV18 Prime. This is the program where we try and demystify macros, markets, geopolitics, all, of course, deeply intertwined at this moment. Before we introduce our special guest of the day, let me just quickly get you up to speed on the conflict underway between Israel and Iran. Israel launched an expanded assault on Iran on Sunday with direct strikes targeting its energy industry and defense ministry headquarters. Some of the visuals are up on your screen. Tehran has launched a fresh barrage of missiles hitting central Tel Aviv and northern Haifa, killing at least 4 people. According to medical officials, 74 people were transferred to hospitals in central Israel. Meanwhile, the intelligence chief of Iran's Islamic Revolutionary Guard Corps and 2 other generals were killed in Israeli attacks on Sunday. Amid escalating West Asia tensions, U.S. President Donald Trump has urged both Iran and Israel to make a deal. Reports also suggest that President Trump vetoed an Israeli plan to assassinate Iranian Supreme Leader Khamenei. Over the weekend, we also heard that the Iranian foreign minister saying that Iran has only acted in self-defense so far.
On the first night, we only targeted military objectives. However, since yesterday, the Israeli regime targeted economic sites, including the Tehran refinery and certain areas in Assyria. In response, starting last night, we also targeted economic sites, attacking economic targets and refineries within the Zionist regime. We do not seek to expand the war unless it is imposed on us. We do not wish for this conflict to spread to other countries or other parts of the region.
Well, as I said over the weekend, U.S. President Donald Trump took to Truth Social, the social media platform, claiming he could bring peace between Israel and Iran, as he's done with other countries. This was, of course, on his way to the G7 summit in Canada. He said he hopes for both conflicting sides to strike a deal soon. Listen in.
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
I mean, this and that. So very difficult to make sense of, really, is there a sharp takeaway from what President Trump has said? I guess not. Sometimes they've got to fight. And of course, at the same time, he sort of indicated there are lots of phone calls, deliberations, talks behind the scenes. And he's hopeful that there will be a deal. But I mean, this is a developing situation. Here's a brief report on what transpired between Israel and Iran over the weekend. Take a look.
Israel and Iran launched fresh attacks on each other overnight into Sunday, killing scores. That's as US President Donald Trump said the conflict could be ended easily, while warning Tehran not to strike any US targets. Iran says dozens have been killed in Israel's onslaught since Friday, including 60 on Saturday, half of whom were children, when a missile brought down a Tehran apartment block. More than a dozen people have been killed in Israel and hundreds injured since Iran launched its retaliatory attacks. On Sunday, Israeli Prime Minister Benjamin Netanyahu visited a residential area in the city of Bat Yam, hit by an overnight Iranian missile onslaught. He watched as rescue efforts searching for missing people buried under the rubble of a collapsed multi-story building continued. Netanyahu said Iran will, quote, pay a heavy price for civilian deaths. The Israeli military has warned Iranians living near weapons facilities to evacuate after both Netanyahu and Trump said Israel's attacks would intensify. Trump has lauded Israel's offensive while denying Iranian allegations that the US has taken part in it. He warned Tehran not to widen its retaliation to include US facilities or interests. In a message on Truth Social, Trump added that the US could, quote, easily get a deal done between Iran and Israel and end this bloody conflict. An Iranian government spokesperson said on Sunday that the country had been ready to hold a 6th round of nuclear talks prior to Israel's initial strikes on Friday. The country's foreign minister has previously said that Iran was acting only in self-defense. The United States has been negotiating with Iran to try and secure a commitment to severely restrict its nuclear program, which Iran says is purely civilian. But Israel sees it as an existential threat because of its weapons potential. Trump gave no details of any possible deal.
Okay, well, that's what transpired over the weekend. Now, the big impact of the conflict, of course, is being seen on oil prices. Remember, on Friday, they jumped about 8%. This morning, Asia, I mean, they've been largely steady around $75 on Brent. But, I mean, the big risk, the big worry is that the Strait of Hormuz is disrupted. I mean, there are disruptions. That is essentially the narrow channel through which some 30% of global oil supply passes through. Bulk of what the Iranian oil, which finds itself in Asia, passes through the strait. It's never been closed before, but worries are rising that we could come to it. This is RBC Capital Markets, Halima Croft, speaking about the key monitorable for global oil supply chains. Listen in.
I think the key thing to watch now will be what will the Iranian retaliation look like beyond the drone strike that we saw yesterday. Obviously, people will be paying attention to the regional energy infrastructure. There's a lot of concern over the Strait of Hormuz. 20% of global oil supply goes through there on a daily basis. But I do think the real question is, do the Iranians do what they did in 2019 when they targeted pipelines, tankers, hit Saudi Arabia's Abqaiq facility? We have a playbook for what Iran can do. I think it looks more like 2019 than the Straits of Hormuz.
Absolutely. And, important monitorable there. What we're going to do is take a quick commercial break here. On the other side, what we'll do is we'll go across to Alvaro Pereira. He's chief economist at the OECD to discuss all of this. And, of course, what are the implications on growth? Growth, especially in the second half of this calendar year, is already looking a little wobbly by most estimates. We'll ask him how he's looking at all of this. Stay tuned. Welcome back to the Global Reset. Now, before we welcome in today's guest, let's quickly hear out from the European Central Bank President, Christine Lagarde, on what she makes of global growth going forward.
Unfortunately, as we were, going into this recovery mode, great uncertainty landed on our global economy as a result of the tariff threats and the announcements that were made and then withdrawn and paused and negotiated. That has dampened global growth expectations. Our projections have been revised downwards. So have the projections of the IMF, the World Bank, the OECD, and most countries are affected. It's not a win-win situation. It's a lose-lose situation that we are looking at the moment. And it's aggravated by the level of uncertainty that is actually putting a hold, if you wish, on many investment projects, on many developments, because investors are not too sure what the future lays ahead.
We have Alvaro Pereira, he's chief economist at OECD, joining us now. Mr. Pereira, great to have you with us on the Global Reset. Thank you very much for your time, sir.
Thank you. Great to be here.
We've been in this kind of a global economic limbo for a long time. Like a not too hot, not too cold. And every year, I think, for the last few, it's been like that. There have, of course, been these big disruptions like COVID, and things have quickened after that and then kind of slowed down. What is your own perspective? I mean, as always, like the last few years, lots of uncertainties. This Israel-Iran conflict is the newest on the table. You've significantly trimmed at OECD your growth forecasts, global growth forecasts for 25. What are you seeing right now?
Well, exactly. Well, remember, in the past 5 years, we had major shocks to the world economy. We had COVID, the pandemic that disrupted everywhere and everyone. Then we had Russia's invasion of Ukraine, which ensued a really large energy crisis, the biggest since the 1970s. And now we have conflicts in the Middle East as well. And so it is absolutely true. And obviously, on top of this, we have tariffs. And so we are faced with really unprecedented uncertainty that we have not seen for many decades. If you look at many uncertainty indicators, in particular for economic policy uncertainty indicators and trade policy uncertainty indicators, we have not seen, since these indicators started in the 1960s, we have not seen so much uncertainty. This is why in our latest forecasts, we say exactly that it's absolutely key to tackle uncertainty to revive growth. But this is why also what we see in the hard data, the consequence, which is basically pervasive uncertainty, led to a significant decline in consumer confidence in many countries, a significant decline in investors' confidence, and this is having an impact on activity indicators. That's why we revised down growth that used to be a few years ago around 4% in the world economy. We revised growth to about 2.9% for the next couple of years all across the world, and almost everybody was revised.
The big one is the US, right, which so far has managed to kind of sort of chug along nicely, although many are calling for US growth to decelerate pretty sharply later this year as well. What are the risks? How concerned are you about the risk of a technical recession in the US, and what would be, the global spillovers if we were to come to that? What's your sense?
Well, we're not forecasting a recession in the United States, but we are forecasting, and we downgraded significantly the growth in the United States. Our previous forecast, just in March, when we took into account some of the tariffs, was around 2.2%. Right now, we are forecasting 1.6% for this year and 1.5% for next year. It's one of the countries that was the downgraded the most, for the simple reason that our estimations, our assessments from the desks, but also our models show very clearly that the countries more affected by tariffs are the ones that usually tend to have lower growth and more inflationary pressures. Well, we know from our models as well that the United States will be one of the most affected countries by the tariffs in the short run. And so that's why we downgraded the United States. What are the risks that we see? Well, there are several risks that we foresee in the near future. Obviously, the biggest risk is further trade fragmentation, which means that there's no deals, and as a consequence, there's an increase in the implementation of reciprocal tariffs. So even if it is 10% more to everyone, we estimated that this will lead to lower growth in the United States of about 1.6% over 2 years. So it's basically 0.8% per year. And for the world economy, less than 1% less in terms of growth. So it's a significant thing over 2 years as well. So it's a significant impact of having more further trade fragmentation. But of course, when we did our forecast about a week ago, we did not take into account what is happening right now in the Middle East. And obviously, this can have a significant impact on the world economy, in particular through energy prices going forward. So this might also be another disruptor. There's two other risks that we think are important to highlight. First, inflation. And we see that service price inflation has been fairly sticky in most countries, whereas goods price inflation started to tick up in the past few months. Obviously, now with the conflict in the Middle East and additional pressures for energy, it's very possible that inflationary pressures could come up once again. And another one that we think it is very important is fiscal risks. That is unprecedentedly high for many countries. Doesn't matter if you're advanced economies or emerging markets. That is very high. And debt pressures and spending pressures are just increasing for defense, to invest in the green transition, but also in many countries for aging costs. And so that means that the risks associated with the fiscal situations are increasing. And obviously, this affects mostly many emerging market economies, but affects many other countries around the world.
Just two or three more numbers out of the way, and then we'll dive into some of the other interesting topics. One is China. What's your forecast there? Europe, do you see Europe re-accelerating? And you briefly mentioned Middle East tension. So just round that answer off with your forecast for oil prices as well.
Well, for China, we downgraded China, but we expect that China, because of the tariffs and the trade barriers, we downgraded China to 4.7% this year and 4.3% next year. It was a significant downgrade. But we also think that the downgrade is not bigger for the simple reason that the fiscal package that the Chinese are planning to do is big enough to offset part of the trade issues that they might face. And so we continue to think that for the Chinese economy, the biggest risk continues to be, besides trade, continues to be the real estate market. The adjustment in the real estate market is, which is taking longer than many people thought. But this is how it works usually in when you have housing. Real estate issues and usually these adjustments take a long time. The second issue that I think that for China is going to be, of course, is trade, and so we think that getting trade deals with the United States and others are going to be key. For Europe, we are forecasting a fairly low growth this year, about 1%. Next year, a pickup, but not really dramatic to 1.2%. The bright spot that we see in Europe right now potentially is the change in that we've seen in Germany with significant investments for infrastructure, about 500 billion euros, and defense. And so here we see that since the Germans have fiscal space, we see that this will help in the short run the German economy, and as a consequence will help a few other European economies. But we're not forecasting very strong growth in Europe. Europe continues to underperform in a way, and so is not growing very fast. And you mentioned also the question of the Middle East. For the Middle East, for the oil prices, usually, again, we forecasted it about a week ago with oil prices are a bit lower than they are right now. I think the evolution of the oil price is going to depend really on how this conflict will evolve. If it escalates, if it becomes much bigger, then it's very possible that will aggravate oil prices. But of course, if there is a de-escalation sooner rather than later, then things might stabilize, and which means that there will be less impact of the energy on the energy markets. But I think the risk there is fairly large, that we might end up with higher oil prices and gas prices. As a consequence, we'll have more inflationary pressures and lower growth for many economies.
Alvaro, let's just talk about what's happening in the world right now as well, right? I mean, there are these forecasts, but then it's also a fast-changing world. Industrial policy as a state tool is back in full force. We are seeing this being used by developed countries. It was scoffed at 10 years, 15 years ago, but now, of course, people argue why this is very much needed. And the only question is how it should be used. We're seeing this in US, we're seeing this in Europe in a big way. China, of course, has championed this for the last, a long time. At the same time, you also have these sort of newer blocks which are forming. The heart of many of these newer blocks are security considerations, old rivalries. Is it a much harder world to forecast for? Alvaro, what's your sense in terms of that? And any insights, any highlights in terms of what are the monitorables, what are the key things to watch out for as we look ahead into the next couple of years?
It's definitely a much harder world to forecast, not only because of the changes in the world, but in particular with the trade uncertainty that we face. I've talked recently with a few very high level officials from major central banks, and they said, well, listen, I work in my central bank for 20 or 30 years, and this is the hardest I've seen in the last 6 months to forecast, because assumptions are changing all the time. And so it becomes extremely difficult. So just to give you an idea, for us, when we did our forecast, we've been working internally with scenarios, different possibilities, different assumptions. Then we make a call, what are the more likely scenarios, but definitely very difficult to forecast. But you're asking me, what are the variables that I think we should pay attention in the next few years? I do think that the most important variable, if you forget trade, of course, we'll see what happens in the short run, but trade obviously is going to be a big thing. We can discuss a bit more if you want to, but I think the variable that we are not talking much, but I think is going to have an impact on major economies are going to go is the evolution of productivity, in particular related to AI. And so we just came out with a recent report that shows very clearly that AI is what it's a rare technology, what is called a general purpose technology that will have a significant impact on the productivity and the production and the organization of work. And we expect, in fact, that this impact is going to be between 1.2, 1.5% per year over the next 10 years in the United States, and a little bit less in many other countries. We think that obviously, if you look at what is happening in the last 2 or 3 years in terms of productivity, there's a big gap opening up between the United States and most countries of the world. The United States productivity is growing right now about 2.5, 2.7%. That has not to do necessarily with AI, but it has to do with the reallocation that took place during COVID. More than 22 million jobs were lost and created. These people usually went to either create their own firms or to larger firms, so productivity went up. There's much larger in the United States, much larger investment, especially in digital technology, much larger than most countries, and this is having an impact again on our productivity. And on the other hand, we also know that firm dynamism went up after COVID in the United States, and this will tend to boost productivity. Now, if you take this into account, that there's already a widening gap between the United States and most countries of the world in terms of productivity, and on top of this, you're going to have AI, in which the United States are much more advanced in this field, it's very likely that this productivity gap will widen. This will have a consequence for monetary policy, for fiscal policy, and for industrial policy, as you mentioned. So I think this is going to be in the near future the topic going forward. The other trend that I think is happening, and that we, outside your country, there's some talk, but not so much, I think, is the rise of India. India is rising. India is becoming, and will become in the next 2 or 3 decades, one of the major players in the world. Very strong reforms that you see in India in many areas. And you see also India diversifying and investing in skills and in infrastructure. And so I do think that this is going to be, geostrategically, is going to be one of the most important developments in the next 2 or 3 decades, thanks to good reforms and strong investment.
India is, in terms of growth estimates, etc., not just for this year, but I mean, as you look ahead, right on the top of the table, Alvaro, in terms of growth and growth prospects?
India right now is the champion of the growth champion of the G20, and I expect that this will continue to be the case. Growth this year, we are forecasting about 6.3 and about 6.4 next year. I expect that, and this is obviously a reflection, not only the internal economy, but in particular the conditions in the world economy. But I expect that India will continue to grow, around 7% in the next few years. And what does this mean? It just means if you continue to grow at 7%, that means that you're going to double your income, double your economy every 10 years. And so, it's a very fast rate of growth. And it's absolutely essential that it continues to be sustained. This will lead to a significant reduction in poverty, a rise in the middle class, and an increase in investment opportunities in India and outside India. So I think this is a really important development, as I said, for the world economy, and we are fairly optimistic about the growth prospects and the development of India.
Alvaro, it's a pleasure having you with us here on this program, this edition of the Global Reset. I think viewers here will be pleased to hear that. Very, very uncertain world, but India is the bright spot with some of the strongest growth estimates from OECD and so many others, mainstream economists that we've had on this very program. Thank you very much for joining us. Hope to see you more often here. Appreciate it very much. Thank you for staying with us here on this edition of the Global Reset. Keep it with CNBC TV18 Prime. More coming up.